Be honest with me for a second. You're scrolling through the news and you see a headline, "The Fed just raised interest rates again," and your immediate reaction? Confusion. Maybe a little anxiety. You kind of nod like you understand what that means, but deep down you're thinking, okay, but what does that actually do to my money? And here's the thing. You're not alone. The Federal Reserve ran a study and found that nearly 2/3 of Americans cannot explain what an interest rate is or how it affects them. 2/3. These are people making financial decisions every single day. Mortgages, car loans, credit cards, investments. And they have no idea that one number, decided by a room full of economists they've never heard of, is quietly controlling the cost of everything in their financial life. That number is the interest rate. And whether it goes up or down, there are people out there, right now, making serious money from that move. And then there are people who don't even know it happened. Today, you're going to be in the first group. What's up, everyone? Welcome back. If you're new here, this channel is dedicated to one thing: making sure you understand money well enough to actually use it. Today, we're breaking down interest rates, why they matter more than almost anything else in the financial world, how they move markets, and most importantly, the exact strategies to take advantage of them, whether rates are going up or going down. Both scenarios. Because smart investors don't just survive rate changes, they use them. Let's get into it. Why interest rates are the heartbeat of the economy. Here's what most people don't realize. The interest rate isn't just about your savings account or your mortgage. It's literally the price of money. Think about that for a second. Money has a price. And when the central bank, in the US, that's the Federal Reserve, in Europe, it's the ECB, when they move that price, everything downstream adjusts. Think of it like gravity in the economy. You can't see it, but it's pulling on everything. Here's how it works at the basic level. When the Fed raises rates, it becomes more expensive to borrow money. Businesses slow down on expansion. Consumers cut back on spending. Inflation cools, which is exactly the point when inflation is running hot. Conversely, when the Fed cuts rates, borrowing gets cheaper. Money flows more easily. Businesses invest, consumers spend, and the economy heats up. Now let's talk numbers, because this is where it gets really interesting. According to the Bank for International Settlements, a 1% change in interest rates can shift the valuation of long-duration bonds by up to 10 to 15%. The U.S. bond market is worth over $50 trillion. That means a single rate decision can erase, or create, trillions of dollars in value in a single day. And stocks? The S&P 500 has historically gained an average of about 14% in the 12 months following a Fed rate cut, according to data from LPL Financial. Meanwhile, sectors like utilities and real estate, which are highly sensitive to borrowing costs, can move 20, 30, even 40% based on rate expectations alone. So yeah, this matters. The psychology most people miss. Now, you might be thinking, okay, I'll just wait to see what the Fed does and then react. And I get it. That feels logical. But here's the trap. The market doesn't wait for the announcement. It prices in expectations weeks and months ahead. By the time you read the headline, the move has already been made by institutional investors with Bloomberg terminals, quant models, and decades of experience. This is called forward pricing. And it's why the market sometimes drops when the Fed cuts rates, because the cut was already expected, it was already baked in, and now there's disappointment because the cut wasn't as deep as hoped. Sound rational? It is. Welcome to financial markets. But here's the good news. You don't need to predict the Fed perfectly. You need to understand where we are in the rate cycle and position yourself accordingly. Let me show you how. Strategy. When rates are rising, scenario 1, the Fed is hiking rates. This is a tightening cycle. Money is getting more expensive. Here's what that means for you and what you should do. Move 1. Lock in high-yield savings and short-term bonds. This is the obvious one, but most people still don't do it. When rates rise, high-yield savings accounts, money market funds, and short-duration treasury bills start paying real money. In 2023, 6-month T-bills were yielding over 5.2%, the highest in over 15 years, while millions of Americans still had their cash sitting in a regular savings account, earning 0.01%. That's not a typo. If you had $50,000 in a HSA at 5% versus 0.01% over 1 year, that's the difference between earning $2,500 and earning $5. $5 for $50,000 sitting in a bank. Don't be that person. Move 2. Rotate toward value stocks and financials. Here's the thing. Banks make more money when rates go up. They charge more for loans while paying depositors less. Classic spread business. JP Morgan, Bank of America, Wells Fargo. These stocks historically outperform during rate hike cycles. Vanguard sector research shows financials outperform the broader market by an average of 6 to 9% during tightening phases. On the flip side, growth stocks, your high multiple tech names, get hammered. Why? Because their valuations are based on future earnings discounted back to today. When the discount rate rises, future earnings are worth less. It's the math of valuation. The 2022 rate hike cycle wiped out over $10 trillion in tech market cap in under 12 months. Move 3. Be very careful with real estate debt. A 3% mortgage versus a 7% mortgage on a $400,000 home? That's the difference between a monthly payment of $1,686 versus $2,761, nearly $1,000 more per month. Per month. That's why the housing market cools dramatically during hike cycles. Don't over-leverage into real estate when rates are climbing. And if you already own, consider locking in a fixed rate before hikes accelerate. Bonus move. And this one surprises people. Consider I-bonds or TIPS, Treasury Inflation Protected Securities. These instruments are designed specifically to benefit from inflation, which typically accompanies rising rate environments. The U.S. Treasury issued I-bonds in 2022 with an annualized rate of 9.62%. That's not a stock pick. That's a government-guaranteed instrument. Strategy when rates are falling. Scenario 2, the Fed is cutting rates. This is an easing cycle. Money is getting cheaper. The playbook flips entirely. Move 1, lock in long-term bonds, fast. This is where most retail investors leave money on the table. When rates fall, existing bond prices rise, because a bond paying 5% becomes more attractive when new bonds only pay 3%. So if you buy long-duration treasury bonds or bond ETFs like TLT before rates drop, you're sitting on price appreciation plus yield. During the 2008 rate cut cycle, TLT, the 20-year Treasury ETF, gained over 30% in under 12 months. That's not equity risk. That's bonds. Move 2, go long on growth stocks and tech. Lower rates mean cheaper capital. Companies that depend on future earnings, think high-growth tech, biotech, clean energy, they re-rate dramatically upward. The discount rate falls, future cash flows are worth more today, multiples expand. After the Fed's pivot in late 2018, the Nasdaq gained nearly 40% in the following year. Move 3, real estate becomes a serious opportunity. When rates fall, mortgage rates drop, affordability improves, and demand picks back up. REITs, real estate investment trusts, are particularly interesting here. They're required to distribute 90% of taxable income as dividends, and they tend to surge in low-rate environments. According to Nareit, REITs outperformed the S&P 500 by an average of 12% in the 2 years following historical rate cuts. Move 4. And this is the deeper insight most people miss. Rate cuts often signal that the economy is slowing or in trouble. The Fed doesn't cut rates because everything is going great. They cut because something is breaking. So yes, you want to be positioned for the recovery, but don't go all in on day one. Dollar cost average in. Scale your exposure as the data confirms the bottom. This is where loss aversion gets people. They freeze because the market is scary, and then they miss the entire recovery. Remind yourself, every major bull run in history started when things looked the worst. The macro framework, putting it all together. Here's your mental model. Think of the rate cycle like seasons. Hiking cycle equals winter. Preserve capital. Short-term instruments. Financials. Reduce leverage. Peak rates equals late winter. Start positioning for the turn. Long duration bonds. Watch credit spreads. Cutting cycle equals spring. Deploy capital. Growth assets. Real estate. Risk on. Low rate environment equals summer. Momentum. Equities appreciate. Watch for overheating. And then it resets. It always resets. The OECD tracks that the average rate cycle, from first hike to first cut, runs roughly 18 to 24 months. You have time. You don't need to be first. You need to be informed and consistent. The mindset shift. Look, most people hear interest rate decision and tune out. They think it's for economists, for Wall Street, not for them. That thinking is exactly why most people stay stuck. The rate environment is not something that happens to you. It's something you can read, anticipate, and strategically position around. The tools exist. The data is public. The Fed literally tells you what it's thinking. It's called forward guidance. You just have to pay attention. So here's your action step for today. One thing, do this today. Check what your savings account is paying right now. If it's under 4%, you are losing ground. Move it to a high-yield account or a money market fund. That's not investing. That's just not leaving money on the table. Start there, and then keep learning. If this video gave you one insight you didn't have before, hit the like button. It genuinely helps more people find this content. Subscribe if you want more breakdowns like this. We go deep on macro, markets, and the psychology of money every week. And drop a comment. Where do you think rates are headed in the next 12 months? I want to hear your take. See you in the next one.